The ultimate goal of dividend investing is to be able to live completely off of our dividend portfolios, specifically from the cash flow we receive from those dividend payments. And while most dividend stocks pay shareholders quarterly, there are about 50 publicly traded companies out there that do pay investors every single month. I don't think I need to explain why monthly dividends are in many ways better than quarterly dividends. Not that I don't invest in stocks that pay dividends quarterly, but obviously when we're paid monthly, it allows for faster snowballing of our dividends when we choose to reinvest. And our living expenses like rent and utilities aren't billed to us on a quarterly basis. Monthly dividend stocks allow investors who live off dividends to better budget for their expenses. There's several reasons why I like to advocate investing in higher yielding dividend stocks even if you're not that close to retirement. First, receiving all of these bigger dividend payments in your brokerage account is extremely addictive. From my own experience, and as I'm sure a lot of other viewers know, seeing these payments deposited into your brokerage account every month definitely motivates me to save and invest more to see those monthly and quarterly dividend payments increase. Another reason is these dividends allow you to plan for when you switch over to living off that dividend income. If your goal is to earn $3,000 per month in dividends, then investing in these higher yielding stocks will give you a better idea of how much more you'll need in your portfolio. So for example, if you invest in these high yielding stocks and you're making roughly $1,000 a month in dividends, you know exactly how much more you'll need to save in order to reach that $3,000 goal. Or maybe you're at or close to retirement age already and you're looking for places to invest your money to get the most bang for your buck every month. If you hold these stocks in a retirement account, you won't only earn a lot of passive income each month, but you'll also end up saving a good amount of money in taxes. So in today's video, we're going to be looking specifically at stocks that pay dividends monthly and offer a dividend yield of at least 8%. We're only looking at individual company stocks, so no ETFs or exchange-traded notes or other types of pooled investments. One thing to keep in mind is that all investing is subject to risk, and I'd encourage everyone to diversify their investment portfolios across different companies and sectors. Some of you might have realized that just a few weeks ago, I released a video titled The Best Monthly Dividend Stocks for Income, and you might be wondering what the difference is between the stocks on that list compared to what's on this list. In that previous video, I highlighted my favorite monthly dividend stocks that have a history of long-term growth and not necessarily the best dividend yields. For example, Realty Income was on that list because of their superb multi-decade-long dividend growth streak, despite the fact their yield is only around 4%. But in today's video, we're going to be focusing on stocks that exclusively pay monthly dividends, have dividend yields of at least 8%, and haven't been on a downward trajectory over the last few years. Because after all, we want to make sure that we're careful and not putting our money into a company that's going down the toilet. So with that being said, let's go ahead and get started. The first company we're going to be taking a look at is Ellington Financial, ticker symbol EFC. Ellington Financial acquires and manages mortgage-related, consumer-related, and other financial assets in the United States. This is a mortgage REIT that acquires and manages residential mortgage-backed securities. The company was founded back in 2007, right before the global financial crisis, and they're headquartered in Old Greenwich, Connecticut. Ellington Financial became a monthly dividend-paying company back in 2019, and their stock currently has a dividend yield of 9.91%, which is pretty incredible. It should be also noted that since the beginning of this year, EFC's monthly dividend payout has increased by 50%, as it now currently pays a 15-cent per share per month dividend. To put that into perspective, if you invest $10,000 into this company at $17.79 per share, and as long as they can continue to pay that 15-cent per month dividend going into the future, you'll be receiving about $84.30 from Ellington Financial every single month, which is pretty awesome, right? And if you can commit to reinvesting those dividends every single month, think of how big of a snowball you might have in a few years. Just by taking a deep dive into their most recent investor presentation, we can see that there's some other really good things here worth noting. It says on page 3 that the management and directors own approximately 8% of the company, which is pretty high. A high insider ownership percentage indicates that the board members have a lot of confidence in their company going forward. I'm also really liking the diversity of their mortgage investment portfolio. If you want to access this presentation for yourself, you can go to their website and then click on For Our Shareholders, click Presentations, and then you can see their latest investor presentation, which is from last November. In summary, this company has some pretty knowledgeable people managing it, and they appear to be doing a pretty good job since the stock market took the plunge back in March of 2020. The next stock we're going to be taking a look at is Dynex Capital, ticker symbol DX. This is another mortgage real estate investment trust, and they're actually the second oldest publicly listed MREIT out there. They invest in mortgage-backed securities, or MBSs, on a leveraged basis in the United States, and they've been around since the year 1987. Dynex became a monthly dividend-paying stock back in March of 2019, and shortly after that there was a stock split. Like pretty much all mortgage REITs, Dynex struggled quite a bit, but their stock price has fully recovered since the plunge in March of 2020. It was during that time they also reduced their monthly dividend amount by 2 cents, which it now currently pays 13 cents per share per month, and it has a dividend yield of 8.78%. One thing I like about Dynex is, while they invest in both agency and non-agency mortgage securities, the non-agency MBSs make up only 3% of their portfolio. Non-agency MBSs are considered riskier than agency MBSs because agency MBSs are backed by government-sponsored enterprises like Freddie Mac and Fannie Mae. During the 2008 financial crisis, a number of mortgage REITs that held a lot of non-agency MBSs actually went under because they weren't backed by government enterprises. I know this might sound pretty technical, but just keep in mind that agency MBSs are safer than non-agency MBSs. When comparing the first quarter of 2021, Dynex has continued to improve in a lot of ways from the last quarter of 2020. As you can see, comprehensive income, book value, and total economic return all saw good gains in just one quarter. Their stock is also up about 19% from a year ago, so there is a lot of good news from this company that should show in their future performance. Up next, we have Prospect Capital, ticker symbol PSEC. This is a business development company that seeks to invest between $10 million to $500 million in each company, and they invest in a wide range of industries, including aerospace, energy, industrial, financial services, and retail. They were founded back in 2004, and they're headquartered in New York City. I've talked about this stock a couple times before on this channel, and as I've previously said, there's some things that I like and things that I don't really care for about this company. One of the best things about this stock, though, is its dividend yield, which is 8.89%, which is the second highest on this list. It's consistently paid out 6 cents per share in dividends for the last few years, but they have cut their dividend a couple times in the past. Out of any other company on this list, Prospect Capital took the biggest hit from the pandemic. They actually recorded negative net income for the year 2020 because of this, although they are projected to post better results for 2021. On the other hand, their stock price has recovered a lot as it's currently up over 61% from this time a year ago. Prospect Capital is currently the third largest business development company in the industry with over $3.64 billion in net assets. Looking at their investment portfolio, we can see that they're pretty well diversified, which is really important for a BDC, although they aren't as well diversified as some other BDCs I've seen. You can see that real estate and consumer finance make up a big chunk of their portfolio. I like the bottom of the page that says hotel, leisure, retail, and restaurants make up a low part of their portfolio, which are industries obviously affected much more by the pandemic. Despite the dividend cuts, if you had invested $10,000 into Prospect Capital 10 years ago and committed to reinvesting those dividends every single month, you would have more than 3 times the number of shares. 3,358 shares today at 6 cents per share would be earning you a little over $200 a month. Compared to a $10,000 investment today would earn you about $73.38 a month in dividends. Before I go on, if this video has benefited you in any sort of way, please consider clicking the thumbs up button below, as well as subscribing to the channel if you want to see more aggressive dividend investing strategy videos, which is what Dividend Bowl revolves around. Thank you all so much for your consideration and support. The next stock on this list is Pennant Park Floating Rate Capital, ticker symbol PFLT. This is another business development company that seeks to make secondary direct, debt, equity, and loan investments in the US. They typically invest between $2 million and $20 million into each company in their portfolio. They were founded back in 2010 and they're based out of New York City. This stock currently has a dividend yield of 8.76% and pays a monthly dividend of about 10 cents per share. When compared to other business development companies, Pennant Park recovered a lot better from the market plunge back in March of 2020. Their stock price is currently up 58% from this time a year ago. We can see, according to Seeking Alpha, that Pennant Park's revenue was seeing year-over-year growth over a long period of time. Even in September of 2020, they reported slightly higher earnings than the previous year. However, as you can see, and is common within the BDC sector, they're expected to report less revenue this year, but they do expect to grow going into 2022. Their investment portfolio consists of about 100 different companies according to their latest investor presentation. I think it's pretty well diversified, and as you can see, some of the more vulnerable industries like hotel, gaming, leisure, as well as restaurants don't make up too sizable of an amount of their portfolio. While they're by no means the largest BDC out there, the diversity of holdings they do have is pretty good. So in summary, out of all the stocks we covered, I'd have to say Prospect Capital is my least favorite on this list. But as I showed you guys, investing in Prospect and reinvesting those dividends over a 10-year period still resulted in good gains. In fact, that was the case for every stock I covered in this video. If you do decide to invest in any of these companies, just make sure you keep your dividend portfolio well diversified. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.